Welcome to this explainer. Today, we're tearing into a massive anomaly that has completely upended traditional macro investing. For decades, expert investors have relied on one foundational assumption. When geopolitical tensions spike or markets panic, you deploy the ultimate macroeconomic parachute. You buy gold. But recently, that parachute totally failed to open. We're going to dig into the data today to answer a critical question. Has gold structurally stopped being a safe haven and morphed into a highly financialized cyclical asset? Let's find out. Here is our roadmap. 1. The safe haven failure. 2. Real rates and debasement. 3. Haven to cyclical asset. 4. Gold versus Bitcoin. 5. Portfolio management. And 6. The macro signal. Part 1. The safe haven failure. Let's get right into the thick of it. The core anomaly really showed its face when the Iran war escalated in late February 2026. This was a textbook macroeconomic shock. When conflict erupts and energy prices threaten to trigger stagflation, uncertainty peaks. Gold is supposed to shine, right? It's supposed to be that independent, zero correlation anchor for your portfolio. But it wasn't. And that forces us to ask, has gold fundamentally lost its safe haven status? Look at these numbers because they're absolutely staggering. Between late February and mid-June 2026, right during the acute phase of an international conflict, gold actually suffered a 5% drawdown. Meanwhile, the S&P 500, the exact risk asset you were trying to hedge against, actually gained 5%. Instead of cushioning the blow, gold moved in direct opposition to its historical mandate. In a lot of portfolios, it literally amplified the volatility. Part 2. Real rates and debasement. To understand this failure, we've got to look under the hood at the macro engine that drove gold up in the first place, the debasement trade. We all know public deficits in the US and Europe are at totally unsustainable levels. Governments aren't going to explicitly default, and politicians sure aren't pushing extreme austerity. So the only way out is financial repression, keeping real rates artificially compressed and letting inflation run a little hot to silently inflate away the debt. Smart money saw this coming and fled to real assets that central banks just can't print. Normally, the bond market is the enforcer here. If you look at the UK, high debt equals higher yields. Switzerland has low debt and low yields. That makes sense. But look at Japan or parts of the EU. Japan has a mind-blowing 240% debt to GDP ratio, yet central bank intervention keeps its real yields artificially lower than fiscally sound nations. This massive distortion, where central banks aggressively manipulate real rates, is exactly what sparked the original gold rush. Part 3. Haven to cyclical asset. Now, here's where the plot twists. The debasement trade completely rewired gold's DNA by changing who is actually buying it. The massive price spike leading into January 2026, that wasn't just central banks de-dollarizing. That's a myth. Central bank purchases actually stayed incredibly flat at around 1,000 tons a year. They're the old buyer with strong hands. The explosive growth actually came from the new buyer, retail investors chasing momentum through highly speculative, leveraged ETF flows. They bought in because the price doubled in a year, and that kind of capital is incredibly skittish. So when the geopolitical shock hit and equities wobbled, these new buyers panicked. We saw a jaw-dropping $15 billion bleed out of ETFs in March 2026 alone. And this wasn't an institutional shift. It was driven almost entirely by retail panic, profit-taking to cover equity losses, and, cruelly, margin calls on those leveraged positions. The fallout is crystal clear right here. Historically, gold's correlation to equities was near zero. But from August 2025 to February 2026, that correlation absolutely spiked. Flooded with speculative retail cash, gold transformed into a high-beta cyclical asset. It basically started trading exactly like a risky growth stock. Selling off hard, the second broader market risk appetite dropped. Part 4. Gold versus Bitcoin. This brings us to a fascinating parallel that macro strategist Ed Yardeni pointed out. The idea that gold is actually the new Bitcoin. For years, Bitcoin was pitched as digital gold, the ultimate fiat hedge. But as we know, both gold and Bitcoin are currently acting as highly financialized liquidity sponges. They are speculative, high-beta assets. When panic hits and leveraged investors are scrambling for cash, neither of them act as true stores of value. They both drop right alongside equities. Take Bitcoin's recent slide back to 2024 levels. The data shows this wasn't some grand macro signal about inflation. It was a localized liquidity event, purely cyclical behavior. Investors were liquidating their speculative Bitcoin holdings just to raise cash for upcoming AI and space tech IPOs, like SpaceX, Anthropic, and OpenAI. Part 5. Portfolio Management. So, as expert investors, how do we adjust? If gold is now this high-beta cyclical beast, how do we manage it without blowing up our portfolio variance? You don't ditch the asset, you just manage it differently. Academic consensus, including deep research from Robeco, shows that in a balanced stock-bond portfolio, a 10 to 15% allocation to gold hits the sweet spot for risk-return. Any more, and you're way too exposed to the crazy volatility of its new status. Any less, and you strip your portfolio of long-term debasement protection. But just holding 10 to 15% isn't enough. You absolutely need strict mechanical rules. Because gold is so prone to momentum bubbles from these ETF flows now, periodic rebalancing is non-negotiable. The best strategies suggest rebalancing every 12 to 18 months, or instantly if your allocation drifts by more than 50%. For example, if your 10% target balloons to 15%, you trim it back. This mechanical approach forces you to capture the beta when it surges and saves you from the psychological trap of buying at the top of a retail bubble.
Part 6. The macro signal.
Looking over the horizon, what's the tell? What's the signal that gold has permanently become a cyclical asset or that it's reverting to normal? Right now, the price is totally deadlocked. Sticky oil prices from the Iran conflict and lingering fears of more Fed rate hikes have killed its momentum. But if inflation structurally cools and the market starts confidently pricing in a return to aggressive rate cuts, that subsequent drop in real rates will undoubtedly be the next major upside catalyst. But honestly, don't just watch the price to gauge its status. The ultimate leading indicator is its daily correlation with the S&P 500. When you see that correlation drop back down towards zero, that is your signal that the speculative retail capital, the weak hands, have been fully flushed out of the market. Only then can gold genuinely reclaim its crown as an independent diversifier.
The renowned researcher Campbell Harvey put this perfectly. We are caught in a massive tug-of-war between a historical mean reversion and a permanent structural shift toward a higher-priced, high-beta, ETF-fueled asset. As an expert investor, your job isn't to crystal ball which scenario wins out. Your job is to build a portfolio that is structurally engineered to thrive in both worlds.
So I'll leave you with this. It's time to heavily audit your allocations. Is your portfolio built for today's market or the market from 10 years ago? Are you still blindly relying on gold as an infallible geopolitical shield, or have you implemented the mechanical rebalancing rules required to tame this new high beta reality? Take a hard look at your strategy, tighten up your parameters, and stay sharp out there. Thanks for joining me on this explainer.